Open power is the new land. That's not a metaphor, it's a valuation mechanism. And most of the GPs raising digital infrastructure funds right now have not fully priced what that means for deployment timelines, return profiles, or where the actual scarcity premium lives in 2026. Here's what I'm watching in real time. Committed capital is sitting idle, not because demand is soft. Hyperscaler lease absorption is running at record pace. Microsoft, Google, Amazon, and Meta have collectively guided to over $300 billion in combined capex for 2025 and into 2026, the majority of which is infrastructure weighted. The demand is not the problem. The problem is that you cannot build into that demand if you cannot get power to the site in time to matter. Interconnection queues in PJM, ERCOT, and MISO are now running between 4 and 6 years for new large load applications. MISO's queue alone had over 300 gigawatts of requests as of mid-2025. Utility upgrade lead times for high-voltage transformers, the actual physical equipment you need to step down transmission voltage to usable campus load, are running 18 to 36 months minimum, and in some cases longer, because transformer manufacturing capacity globally did not anticipate this demand curve. So what happens? Entitled sites with secured power agreements and existing fiber routes become the scarce asset. And that scarcity is now fully reflected in how those assets trade. The data layer. Let me put some numbers on this because the transaction data is more instructive than the narrative. According to CBRE's 2025 Global Data Center Trends Report, vacancy in primary North American data center markets, Northern Virginia, Dallas, Phoenix, Chicago, Silicon Valley, compressed below 2% in the second half of 2024. That's essentially full. Asking rents in Northern Virginia crossed $160 per kilowatt per month on a wholesale basis in late 2024, up from roughly $115 2 years prior. That's a 40% rent move in 24 months in the most liquid, most competitive market in the world. In secondary markets like Columbus, Indianapolis, and Salt Lake City, vacancy is slightly wider but moving fast, and the rent trajectory is similar. JLL's data center outlook for Q4 2024 flagged that absorption in the top 6 North American markets hit approximately 5,600 megawatts for the year, a number that would have seemed implausible 5 years ago. Supply deliveries could not keep pace. The absorption to supply ratio was running above 1.5 to 1 in primary markets, meaning for every megawatt delivered, operators absorbed 1.5. That imbalance is structural, not cyclical. Now look at the transaction side. Green Street and Real Capital Analytics data show that stabilized, powered shell data center assets in primary markets traded in the 15 to 18 times EBITDA range through 2024 into early 2025. Cap rates effectively in the low 4s to high 3s for trophy assets. But here's the more interesting data point. Development sites with secured power agreements, sites that are not yet built, carrying no NOI, are commanding land premiums of $2 million to $5 million per megawatt of contracted capacity in established corridors, depending on the interconnect point, transmission voltage available, and queue position certainty. That number deserves a full stop. Land with no building, no tenant, no income, trading at 8 figures because of a 50-megawatt power contract attached to it. The Ropes and Gray data center investment analysis published in early 2026 specifically flagged this valuation inversion as one of the dominant structural trends, reshaping how private equity underwrites new development, noting that power contract certainty has become the primary underwriting variable ahead of location, zoning, or even lease structure. To make it concrete, I am aware of transactions in the Mid-Atlantic and Texas corridors where raw land that would have cleared $500,000 to $2 million on its own merits in a prior cycle sold at $40 million to $60 million because the seller had an existing large load service agreement with a relevant utility and a position in the interconnection queue with a defined commercial operation date. The land was nearly incidental to the pricing. The mechanism. Why is this happening now specifically? 3 converging pressures, and I want to be precise about which one is the dominant driver. First, the AI training and inference buildout is demand that nobody in utility planning had modeled at this scale or velocity. The shift from general cloud compute to GPU-dense inference clusters has compressed the timeline from this is a trend to this is an emergency for large load customers. A single next-generation AI training cluster can draw 50 to 200 megawatts continuously. That is the equivalent of adding a small city to a substation without warning. Second, the grid is not ready. The U.S. transmission infrastructure investment deficit is well documented. NERC's 2024 long-term reliability assessment identified broad swaths of the Eastern Interconnection at elevated risk of energy shortfalls under high-load scenarios. Utilities are not withholding power agreements out of bureaucratic inertia. Many simply cannot commit capacity they do not have the infrastructure to deliver reliably. New transmission lines take a decade to permit and build. Substation upgrades take 2 to 4 years at best. This is a physical constraint, not a policy one. Third, and this is the dominant mechanism, the interconnection queue reform process under FERC Order 2023 has changed the rules of engagement. The new cluster-based queue study process is more rigorous, which is ultimately correct policy, but it has created a transition period bottleneck where legacy queue positions, those secured under the prior first-come, first-served regime, carry extraordinary optionality value. A developer who locked in a queue position 3 years ago has an asset that cannot be replicated on the same timeline by a new entrant today regardless of capital availability. That queue position, combined with a signed large load tariff agreement, is the moat where mid-market capital fits. The hyperscalers and the Tier 1 colocation operators, Equinix, Digital Realty, Iron Mountain, QTs under Blackstone, are operating at a scale and a lease structure that is simply not accessible to mid-market capital. They are signing 10 to 20-year absolute net leases at 50 to 500 megawatt scale, and they are doing it with balance sheets that can absorb multi-year pre-development periods, where mid-market capital, and I am talking about check sizes in the $20 million to $100 million range, finds asymmetric positioning is in 3 specific subsegments. 1. Entitled sites in secondary and tertiary markets with secured but underutilized power agreements. These are often assets held by industrial operators, municipalities, or legacy telecom companies that do not have the development expertise or capital to realize the value. The power agreement exists. The fiber route exists in many cases. The site is zoned appropriately or zoning is achievable. The seller does not know what they have, or knows but cannot execute. That is a buy-side information and execution gap. 2. Structured power JVs with independent power producers and cooperatives in markets where grid constraints have open non-traditional supply paths, and site generation, behind-the-meter natural gas or renewable plus storage configurations. These structures allow a developer to de-risk the utility queue entirely by essentially becoming their own power provider for the first phase of a campus. The capital need here is on the generation infrastructure, and it can be structured as a separate entity from the real estate, which creates interesting tax and financing optionality. 3. GP stakes and preferred equity positions in smaller development platforms that have the site control and power relationships but are undercapitalized to execute. These platforms are raising their first or second institutional round at valuations that do not yet reflect the full scarcity premium in their power assets. Preferred equity at a 12 to 15% current pay with meaningful upside participation through warrants or conversion rights is a structure I am actively evaluating in this segment. Counter positions and risks. The bears are not wrong about everything, and the risks here are specific enough to name. The concentration risk is real. Northern Virginia has absorbed capital so aggressively that Loudoun County has effectively imposed a moratorium on new data center zoning approvals in certain districts. Prince William County's Digital Gateway project continues to face political and environmental opposition. The lesson is that site control and power in a single submarket does not equal a fundable deal. You need to model the local political and regulatory risk as a first-order variable, not a footnote. Power cost inflation is a live risk. Behind-the-meter generation solves the availability problem but introduces commodity exposure, natural gas basis, capacity market volatility, carbon regulation, that is material to long-term lease economics. A 10-year net lease priced at today's power cost assumptions looks different if generation costs move 30 to 40%. The AI demand curve itself carries model risk, inference efficiency improvements. The trajectory that drove DeepSeek's compute cost headline in early 2025 could compress per query power demand faster than current underwriting assumes. I am not on the camp that says AI compute demand reverses. I think the efficiency gains drive volume increases that more than offset per unit demand reductions, but a thesis that depends on a specific megawatt absorption forecast over 10 years needs to price that uncertainty honestly. Finally, construction cost inflation on the mechanical and electrical side, switchgear, UPS systems, cooling infrastructure, has not normalized. Turner Construction's cost data shows data center hard costs running 15 to 25% above 2021 levels depending on market and spec level. That compresses development yields and extends the period before a project earns its cost of capital. The position I'm taking. Here is what I am actually doing. I am actively evaluating 3 site positions, one in the Carolinas, one in the Ohio Valley, and one in Texas outside the primary Dallas corridor, where the underlying thesis in each case is a legacy power agreement attached to either an industrial site or a decommissioned facility, combined with proximity to dark fiber routes and achievable zoning. In each case the land basis is sub $5 million, and the power agreement has an estimated contract value in the $15 million to $40 million range, based on comparable queue position trades. The development path in each case targets a 20 to 40 megawatt initial phase, with expansion optionality to 80 to 100 megawatts, which keeps the asset in the range that regional and national colocation operators can absorb on a wholesale lease basis without requiring a hyperscaler relationship to exit. On the structured finance side, I am looking at preferred equity positions in 2 development platforms that have site control and signed large load tariff applications, but need pre-development capital to get through the queue process and secure anchor tenant LOIs. The target structure is 13% current pay preferred with a 2 times participation cap on equity upside, positioned senior to the GP promote but junior to any senior construction debt. I am not chasing stabilized lease assets in primary markets at sub 5% cap rates. That risk return is not where I want to be positioned in this part of the cycle. The edge is in the pre-development and entitlement phase, where the power asset is the underwritten value and the construction execution is the risk I am being paid to take. Close. The summary is this. In 2026, data center investing is not a real estate trade. It is a power infrastructure trade that happens to resolve into real estate. The developers and allocators who understood that 18 months ago are sitting on assets that are now commanding premiums that would have looked irrational in a prior underwriting framework. The ones who are still underwriting to megawatt capacity and absorption forecasts without anchoring to secured power position are going to find themselves with committed capital and no deployable deal flow. The entry point that still has room is sub 100 megawatt, secondary market, pre-development, where the power agreement is the asset and the execution is the value creation. If you have a site, a power agreement, a platform that fits this structure, or you are a co-invest principal looking at this segment, DM me at @BrodiOfficial. I route those conversations personally.